John Samuels, thank you for joining us on Tax Notes Live. And we wanted to talk today about corporate inversions. They've been in the news a lot lately, and there continues to be a debate regarding how harmful they are to our national interest. Some commentators make them out to be an employment problem and that jobs might go overseas. Other critics see these transactions as merely a revenue concern and that less tax will be collected. And still others maintain that inversions reflect an underlying competitiveness problem and that they're more of a symptom than the actual ailment of our economy. What are your views on these characterizations?
So thanks, Bob. You've asked a number of questions there. Let me start by addressing the question of whether these so-called inversions reduce employment in the United States. I think it's important to recognize at the outset that a corporate inversion is really nothing more than a cross-border merger between a U.S. company and a foreign company. And the foreign corporation can be bigger than the U.S. corporation or smaller than the U.S. corporation. But it has to be at least 25% the size of the U.S. corporation. It can't be a minnow to ensure that it is a real transaction. So it's not just the reincorporation of a U.S. company abroad. Now, in all these cases, the foreign corporation ends up being the ultimate acquirer. So in cases where the U.S. company is larger than the foreign corporation, so where its shareholders end up with more than 50% of the stock in the combined company, the U.S. management is likely to stay in place and almost always does. Transactions like the Medtronics deal or Pfizer. And I think in those cases, there's very little risk to the U.S. of loss of jobs or employment. But in cases where the foreign company is larger than the U.S. company, it's then likely that the managers of the foreign company are going to run the combined entity after the merger. So at a minimum, there's going to be a loss of headquarters jobs. And there's evidence that when companies are run, or that the headquarters jobs determine lots of other jobs, both jobs that support headquarters like legal, accounting, and other supporting functions, and that the farther away jobs are from headquarters, the more fragile they are. So, and I would note, in cases where the U.S. company is larger than the foreign company, it actually may be protecting U.S. jobs because the U.S. company, after the merger, is no longer able to be a target to be taken over by a bigger foreign company. It's kind of taken itself off the playing field. On the question of whether this is a revenue concern, these transactions are revenue concerns, I think yes, there may be a revenue concern from having U.S. companies taken over by foreign companies or these so-called inversions, but that's largely presented by the new opportunity the U.S. company will have to strip the U.S. base by having the U.S. company make interest or other deductible payments that will be in the U.S. to a related company that's owned by the new foreign parent that's located in a low-tax country. Now, there's several things to note about this income or earnings stripping issue or proposal. First, it's not limited to inversions, but it applies to all foreign subsidiaries or all U.S. subsidiaries owned by foreign companies in the United States. And it can be addressed separately from inversions by, for example, tightening Section 163J, and indeed, which has a 50% EBITDA limit on deductible interest. Secondly, I would note, at least the proposals to do that so far haven't involved a lot of revenue. In the Camp bill that reduced the tightened 163J from a 50% to 40% EBITDA limit, it raised only $2.9 billion over 10 years. And while that's money, it's not a lot of money in the context of these transactions. But I think the answer is the revenue impact or concern from these takeovers or inversions can be addressed through tightening the tax-deductible payments made by U.S. companies to their foreign parents. But you got to be careful to not tighten it too much, or you might discourage elastic inbound capital investment coming into the U.S. So, and I would add that I think there is no revenue concern from taxes that would have been collected if these U.S. company had remained a U.S. company and repatriated its foreign earnings, because it was never going to repatriate those earnings, not until the cows came home. So no revenue loss there.
Right. Well, and the last part of that question was about competitiveness. Is there a competitiveness deficit, so to speak, in our overall corporate regime that's the ultimate incentive for these types of transactions?
Well, again, it depends on what you mean by competitiveness, but I think the answer is yes. If a U.S. company is operating in a foreign market where it is facing a ultimately 35% tax rate on its foreign earnings, and its foreign competitor is not facing that same level, that same tax rate, the U.S. company is not going to be able to price its goods or services at the same price as its foreign competitor. Now, the U.S. company can avoid U.S. tax, but only by leaving its foreign earnings offshore, and there is a implicit tax in that, the cost of the lockout, which we can talk about later. But there is, if there weren't, let me put it another way, if there weren't a competitive impact, I doubt you would see in virtually every cross-border, not every, but most cross-border mergers, having the foreign parent be the ultimate, or the foreign company being the ultimate parent of the transaction. And the competitiveness impact can affect itself not only in being able to price products, but having a lower return. If you price at the same level, which you probably do to meet the foreign competitor, then you have a lower return, you're going to have a higher cost of capital.
Yeah.
So the answer is yes, I think at root there is a competitiveness problem.
Well, yeah, you mentioned the scenario. Is it the foreign parent or a domestic parent after the merger? It seems like it's almost always a foreign parent for exactly the reasons you mentioned. I mean, well, I'm sure you can cherry pick one case where there's a U.S. parent, but the vast majority of these transactions, it's always a foreign parent.
Well, sure, and it makes sense because the foreign company, which is a legitimate company, has lots of earnings of its own outside the United States. If the U.S. company were to become the ultimate parent, then you would be sweeping all of those earnings into the worldwide U.S. tax net.
And why would you do that?
And why would you do that? Indeed, in one of the exam questions I give my Yale students every year, I ask them who should be the ultimate parent in the cross-border merger, a U.S. or foreign company. And I can tell you if they get that answer to that question wrong, they generally don't do well on the exam. Having said that, they're all smart students.
Yes, I can't imagine any of the folks at Yale would say, yeah, let's set up a structure with the U.S. parent.
But that's the problem. We should not have that artificial bias.
Well, let's talk about the lockout effect just very quickly. If Congress were to somehow eliminate the lockout effect, and I guess it might depend on how they do that, and I'm not talking here about going to an accrual system, say, but if we went to a territorial system, then does the desire to invert, does it largely dissipate? What's your reaction to that line of thinking?
So I think the answer is yes, it does. I think lockout under our current worldwide system that prevents U.S. companies from getting access to their foreign earnings, either to invest in the U.S. or to pay to their shareholders, is the principal driver of inversions. And it's not the U.S. tax rate, because even after the acquisition, the earnings of the U.S. company in the U.S. will be still subject to the U.S. tax rate. And to the extent inversions are driven by earnings stripping, because you want to reduce the high U.S. tax rate, we can address that question separately. So the answer is, I absolutely think if we were to adopt a territorial system like the rest of the world's, and I'm going to come back to that in a minute, inversions would, the pressure to invert or indeed have foreign companies the ultimate acquirer in a cross-border merger would really dissipate.
Mm-hmm.
Now, there's a big caveat there, which is adopting a territorial system or to eliminate the lockout and have it look like the rest of the world. Because if at the same time we adopted a territorial system and, as you say, adopted other provisions that would impose tax penalties on being headquartered in the U.S., like, for example, a minimum tax on active foreign income of U.S. companies,
sure,
we're going to still see inversions occurring after, or foreign corporations being the preferred acquirer even after tax reform, because the U.S. system would be out of line with international norms. Or another way to put it is we could eliminate the lockout by repealing deferral. But if we were to repeal deferral, I have no doubt what would happen to takeovers of U.S. companies. Indeed, we have an example of that with what happened to the shipping industry when in 1986 the Congress repealed deferral. So the answer is we really need to have a system that is aligned with the territorial system, that is aligned with the systems of most of our significant trading partners. And I think that would put an end to these so-called inversions.
Well, that's a really good point. It's not just enough to get rid of the lockout effect. It matters how you do it. Well, one last question here, John. Presidential candidate Hillary Clinton wants to modify the current rules for discouraging inversions. In fact, her campaign is making this something of a priority, apparently under the belief that recent notices don't go far enough. And her proposal would lower the applicable ownership threshold from 80% to 50%. And then there's also talk of an exit tax on overseas profits and more restrictive earnings stripping rules. This sort of patchwork approach, in your view, is this the direction that we should be going in?
So the answer to that is easy. Absolutely not. I think stopgap measures have proven to not work in the past, and I don't think they will work in the future. And indeed, this proposal to reduce the 80% threshold to 50% is one that has been proposed by the administration for several years, and a number of people have pointed out it would have not only not be effective, it might well have some unintended consequences. It wouldn't be effective because it would, in the first instance, companies, U.S. companies, would be targets for larger foreign companies. Secondly, to avoid that, U.S. companies could easily spin off or engage in so-called spin versions of their foreign operations to put them into, in effect, bite-sized pieces that could be acquired by foreign companies. Indeed, the reason these stopgap measures are not going to be any more successful in the future than they have been in the past is because of a simple, basic economic truth that income-producing assets in today's global economy are ultimately going to end up being owned by companies in whose hands they produce the highest after-tax rate of return.
And there's no escaping that. What you just said right there, I mean, that's a truism. There's no getting around that.
Not at all. Indeed, if we could stop all, just imagine for a moment, engage in a thought experiment, and we could stop all foreign acquisitions of U.S. companies, then U.S. companies would find other ways to move their foreign operations into the hands of foreign companies where they'd be more valuable because they were subject to lower taxes. For example, there'd just be direct asset sales. Merck sold its consumer products division, put it up for sale, and it ended up being bought by Bayer, a German company. U.S. companies were not in a position to compete because they would have had to pay U.S. tax on this consumer products business in China and around the world when German companies would only pay the local taxes.
Yeah, and yet nobody calls that an inversion because it doesn't involve a sale of shares.
Well,
it's a sale of assets.
It isn't an inversion, but what it is, inversions, I'm going to come back to this, are just one form in which the foreign operations of U.S. companies end up being owned by foreign acquirers. Foreign startups are another. If you're going to start up a company today, or think of it as creeping, I think of loss of U.S. market share by U.S. companies is a form of a creeping acquisition of U.S. companies' operations. It's not so visible, but it's happening, and that's again because of the simple and basic economic truth that assets want to end up and will end up in today's global economy being owned in the hands of the company or person where they produce the highest after-tax rate of return.
Yes, and political tinkering doesn't seem likely to change that.
I'm afraid not. Indeed, and this exit tax, I think, again, I've heard about it. I haven't seen any description of it or any details, but as at least my understanding of several that have been floated, would impose immediate U.S. tax on the deferred foreign earnings of a U.S. company if they were taken over by a foreign company, whether in a friendly deal or a hostile deal. And I have to say, I find this first puzzling as a matter of tax policy. I'm not sure, when a U.S. company is acquired by a foreign company, the U.S. company still owns its foreign subsidiaries, and the earnings of the foreign subsidiaries are still subject to U.S. tax if they're brought back to the United States. So it isn't like they've escaped the U.S. tax net. And indeed, the first set of Treasury's anti-inversion regs make it much more difficult for U.S. companies to do anything with their historic earnings after a foreign acquisition without having U.S. tax triggered. So I'm not sure what there is about the takeover of a U.S. company that should trigger the loss of deferral any more than by a foreign company any more than its takeover by a U.S. company. But I think what's intended by this is to try to throw another roadblock in front of foreign acquisitions of U.S. companies. And like all stopgap measures, it's going to be ineffective and probably produce unintended results. And the reason I think it'll be ineffective is most companies are forward-looking. And so when you're thinking about who should be the ultimate parent in a cross-border merger, you're looking about the tax savings on your future foreign earnings.
Right.
And you would weigh the tax savings of having your future foreign earnings not subject to the worldwide U.S. tax net, and then weigh that against the tax cost of this so-called exit tax. And because most of the growth of U.S. companies are from outside the United States, 95% of the world's population and 75% of the world's purchasing power is outside the U.S. The bigger tax savings are almost certainly going to be from reducing the rate on the prospective or future earnings of U.S. companies, which means the transactions will still proceed even if there is this exit tax. It's just that the foreign acquirer will pay less money for the U.S. company. This tax will be a cost to the deal and likely to be borne by the shareholders of the U.S. company who will get less for their stock. And those shareholders, as we know because of the home country bias, are in large part U.S. citizens and residents. So I don't think it would be effective. And I think it may well have the unintended consequence of accelerating some foreign takeovers. So the easiest way to see this is imagine a U.S. company that's got $100 million of deferred historic earnings today that would be subject to the exit tax, but it's growing fast outside the United States, and it expects to have $200 million or $300 million of foreign earnings in 3 years from growth in its foreign earnings. It assumes it may well be taken over or want to have the option of merging with a foreign company. If it merges today, it pays the exit tax only on its current $100 million of deferred foreign earnings. But if it waits, as each year goes by and its earnings accumulate, it's going to have a larger tax exposure. So it makes sense to merge with a foreign company and leave the U.S. today to avoid the exit tax. And indeed, it's just another example of why trying to prevent U.S. companies from leaving the U.S. is not the right approach, and instead I think we need to start thinking about what can be done to make it more attractive for companies to stay here. And of course, an exit tax like this would make it much more attractive to start up your company outside the United States. And again, there's nothing we can do about that. So again, I'm afraid it hasn't been fully thought through and is likely to result in, this is an exit tax, results that are unintended.
Well, it sounds like the real solution here is fundamental tax reform that lowers a marginal rate and goes to a territorial regime.
So the answer is, I think that is right, and it may not be where some policymakers want to go, but in today's global economy, I really don't think we have a choice. And indeed, what we need to do is harmonize our tax system with the tax systems of most of our major trading partners, most of the large capital exporting countries. And if you look at their tax systems, they are remarkably similar. I mean, the UK, France, Japan, and it's almost as if they got into a conference room and agreed on how to design a tax system. And they have the same goals we do. They want to collect revenue. They want to advance the standard of living of their citizens and residents. We're not smarter than they are. We don't know anything they don't know. And all we need to do is align our rules and systems with theirs, particularly in the how you tax the active foreign earnings of multinationals headquartered in your country. And then I think U.S. companies will be able to compete on a level tax global playing field.
John Samuels, thank you very much for commenting on these issues, and thank you for joining us on Tax Notes Live. We hope to have you again on the show sometime soon.